Hi everyone, this is Mike from Mod Capital Management, and today I'm going to give you a little bit of a preview in terms of what I'm seeing for the non-farm payroll report on Friday. So obviously, markets have significantly repriced following Jay Powell's testimony in front of the Senate on Tuesday, and basically we've seen a big change in Fed fund futures, with the market now pricing in significantly higher rates. And what's interesting, I guess, is that you've seen really a very, very large repricing in rates in really just about a month's time, where we had, at one point pricing in a terminal rate of about 4.88% back on February 2nd. That was one day before that January non-farm payroll, and now you have markets pricing in a peak terminal rate of 5.6% in October, and you've seen the December contract go from 4.46% to now trading at 5.54%. So this has been a very, very big repricing, and it's come basically on the heels of very strong economic data from in the U.S. and much hotter than expected inflation data in the U.S. And so, Jay Powell sort of opened the door for a potential 50 basis point rate hike. He also indicated again that rates would likely have to go higher than what was previously thought. And so that really puts a lot of emphasis on this job report, especially this one that comes on Friday, because again, this is going to be the last job report we're going to see before the next FOMC meeting. It also is because, the Fed's going to be entering a blackout period. And so that means that, if you get a really strong job report, there's going to be no time for the Fed to communicate with the markets that it could go 50, because the market's been generally thinking that Fed's is in a path of only 25 right now. And of course, in early next week, you're going to get CPI. And so, this 224,000 change in non-farm payroll would certainly still be a very, very healthy number. The big thing, of course, is the unemployment rate of 3.4%. That's been trending lower. And then the other thing that may be even more important is that average hourly earnings are expected to increase from 4.4% last month to 4.7%. What also is key is revisions, because we've seen really big revisions in all these numbers in previous months. So it's going to be important not only to look at the headline numbers, but also to look at the revisions and see if the revisions are higher or lower than what last month was. And so that really sort of leaves the market in a precarious spot, because while it may seem as if we're on a certain path, or that the path can change very quickly and very easily, we've been learning that. And so generally speaking, we've seen the 2-year yield move up to 5.05% following Jay Powell. And the truth of the matter is that rates are really getting very, very high right now. And the question becomes is how much higher can rates go? Well, from a technical perspective, I mean, we can see that if we go back and we look, from a technical perspective, there is some resistance around 5.1%, and then again around 5.25%. So there is certainly some strong resistance coming up in the 2-year very soon from a technical perspective. And the other thing here is, if you notice, that the RSI is getting into overbought territory. So again, what this may be telling us is that the 2-year may be hitting sort of a resistance area very soon in this 5.10 to 5.25 region. It wouldn't be surprising to me to either see the 2-year sort of stall out or maybe even retrace a little bit. When we look at the 10-year is also moved up rather dramatically, and the 10-year, unlike the 2-year, hasn't kept pace, and that's largely because we've seen inflation expectations reprice some. And so usually when short-term rates rise rather rapidly because of expected Fed rate hikes, you tend to see the back end of the curve not perform quite as well, because that means that future growth is going to be lower. And so you've seen the 10-year yield basically not move higher. But more importantly for the 10-year yield is that it stays above this 3.9% level. If it stays above this 3.9% level, I think the 10-year is still on course to head back towards this 4.25 level overall. And if we take a look at the 10 and the 2 on this chart, because this chart goes back further in time, you'll see that this has been a spread that hasn't been this deeply inverted in a very long time. So at some point, we're going to have to think that the jobs data supports the inversion being this low. And the reason I say that is because historically, the job report, the unemployment rate, tends to be a pretty good indicator in terms of where the 10-2 spread is going to go. And you can see typically that the 10-2 sort of rises in anticipation of the unemployment rate rising. At least that's what's happened during the last couple of cycles. And so if we're at a point where the unemployment rate's going to stay steady down here at this 3.4% region, which is what is expected, I would think that we'd begin to see the 10-2 curve begin to flatten out, at least, at the very least. But again, I think there is room for the 10-year yield to continue to rise. To this point, you haven't really seen equity markets respond all that much. Here's this 80-day cycle pattern I had pointed out to you not that long ago. And you can see that that point has still kind of continued to remain the high point in this cycle. And more importantly is when we look at the trend now, you can clearly see that there's a decent downtrend forming on the S&P 500. And what's more important here is whether or not we've made some sort of change in trend, because you can see here that we clearly have a clear uptrend in place. We came down, we broke it, we came back up above it, tested it again, and then we came back down below it and broke it again. But the question is whether or not that there's now a change in trend, because what we've seen, not only that, is that you've seen this new sort of, now with this new low here, you can see that there's a new trend line. And so that's really sort of giving the S&P 500 a little bit more room to maybe move lower, because you can see here's your 200-day moving average. Right below it is the trend line, and then right below that is 3,900. And so that really creates this zone between 3,900 and 3,925 that could offer very, very major support for the S&P. But it is also worth noting that you're clearly in a downtrend on the RSI again, suggesting that momentum is still very much negative. And that we're not even close to being oversold yet. So there is certainly momentum to the downside here. And really all it's going to take is a break of this support level around 3,900. The other thing that's interesting is that the put wall, which is based on gamma levels, option market positioning, shows that the big support level is also at 3,900. So that really sets up 3,900 as a very key level of support for the S&P 500. If you get a hot data point on Friday from the BLS job report, there's certainly the risk that 3,900 will break. And if it does break, you're talking about your next major levels of support around 3,780 to 3,800. And when we look at the Nasdaq, it's sort of a similar setup here, because we have a Nasdaq that's also trending lower. Again, you can see clear downtrend in place. You can see clear downtrend in the RSI. You can also see that this uptrend is also sort of moved out a little bit here. You have some strong resistance around 11,897, both from the uptrend and from the 200-day moving average and from the support level. That sort of corresponds to around the 290 level on the QQQ. Just like on the S&P 500, this 290 area is the put wall, which means that options markets are positioned in such a place that if the market were to get to 290, you could see people who own puts begin to sell them, which causes market makers to begin to unwind some of their hedges, which allows kind of offer support. But again, this all hinges on what the job data is, because if you get a hot job report, all these support levels are probably going to break in anticipation of the Fed raising rates by 50 basis points. Currently, the market's seeing a 63% chance of the Fed raising by 50 basis points come the March meeting. So obviously, if those odds go higher again, that's going to put a lot of pressure on equity prices overall. And so I hope this helps you. And if you have any questions, you can be sure to reach out. Thank you. Bye.